Did this happen to your investments during COVID-19? This is the Toronto stock market, March 2020, with a massive negative 37% decline, but you knew this already. But did you know that there are portfolios that did not suffer declines during this period? In the next 5 minutes, I'm going to share with you a little known secret on how to protect your assets from future declines. Hello everyone, my name is David Aaron. I'm a business wealth advisor, and for over 20 years, I've been providing solutions to business owners, incorporated professionals, and high net worth families. I want to share with you a little known secret. You see, many investors are in what I call cookie cutter portfolios. When you invest, you're asked several questions to identify your risk tolerance. This is not only a provincial requirement, but it's absolutely critical to achieving your investment goals. The problem here is there's a really good chance you're experiencing tremendous volatility in your portfolio. And the answer you've been given by your advisor is just to take a deep breath and stay invested. But doesn't it make sense just to minimize the volatility in your portfolio, to minimize the extreme swings in your portfolio, rather than having you hold your breath? Let me explain. The top chart is the COVID-19 Experience. It's a little busy, but it's actually really simple to get through. We're going to compare two cookie cutter allocations. The first is a 40-60 equity fixed income split. That's the dark blue line. The second is a 60-40 equity fixed income split. That's the light blue line. So you see the values are just reversed for these two allocations. Both allocations experienced wild swings and market declines in March, as you can see where the red arrows are. But throughout the year, they moved forward and up and ended the year nearly identical, nearly side by side, despite their very different allocations. The bottom chart illustrates 20 years of annualized returns for all asset classes. Now, sadly, the average investor only achieved 2.5% rate of return. In fact, it's very likely your home experienced a better rate of return over this period than your own investment portfolio. Now, if you think volatility doesn't happen that often, think again. Here's the volatility for the last 20 years in the Toronto stock market. On the far left-hand side is the dot-com bubble bursting with negative 35% rate of return. Sounds familiar? When we move across this timeline all the way to the very top right-hand corner, that's the COVID experience, negative 33%. So you can see volatility has been in our market for 2 decades easily, and many times before that. But this is really important for you to know, because if we are to learn anything from history, that history will repeat itself and we will have future corrections. Let's get back to that risk tolerance. A conservative portfolio has more fixed income, and as you move higher up the risk level, more equity is introduced and fixed income is lowered, thus creating a riskier allocation. The question you want to ask yourself is, how can I achieve a better rate of return while reducing risk? Let's examine this. If you had taken $100,000 and invested in that 60-40 portfolio, the 5-year rate of return, you would have achieved $150,000, a 7.44% rate of return. $100,000 going into the 40-60 portfolio, $140,000 and 6.71. And if you had invested in a actively managed portfolio over the same period, that $100,000 would have nearly doubled to $190,000, producing 9.72% rate of return. There's no trickery here. It's just better performance through better portfolio management. I want to show you something else. This is the chart of the 5-year Toronto stock market with a 60-40 equity fixed income split. Notice that massive decline. Here's the 40-60, and now I know the screen changed really quickly. I'm going to flip back and forth so you can see that both of those portfolios, despite their very different allocations, reacted almost identically. Here's the 40-60, there's the 60-40. Back to the 40-60, 60-40. You see that? It's almost identical. Now, the peace of mind portfolio. Now, there's still volatility in the market. That's what was going on, but this portfolio did not experience the kind of massive decline that you saw in the 60-40 and the 40-60. Your money went down very little, but then kept on marching on, nearly doubling in that same period. If you'd like to learn how to achieve this kind of performance in your portfolio with peace of mind, give me a call, press the buttons below, and I'm happy to get in contact with you. Thanks again for watching. Appreciate your time.